And I mentioned yesterday that the C corporation tax rate is 21%. And so how do we figure out, is it better to have a C corp or an S corp? Because remember, an S corp is exactly the same as a C corp from an asset protection standpoint. So what we're looking at is, do we want to tax at 21% at the corporate level, or something at the shareholder level between 10 and 37%? Now, two things to note here. One, this is taxable income. So after I talk about some of the tax deductions you're going to get, this is taxable income. This is also for individuals, okay, single individuals. We double these amounts generally for married. So you can see that if you're a married couple and your taxable income is under $178,150, the C corp is starting to look pretty good from solely a tax perspective on where the income is going to be taxed. Obviously, if your taxable income is, you're making $1 million a year here, and you're going to pay 37%, if it's an S corp, having that 21% is going to look real nice. So these are some of the thoughts of, where is my taxable income going to fall to come up with the tax bracket? And then how does that play out relative to the corporate tax rates? And also, how am I going to get the money out? So do I need the money from the business? So some businesses, so my law practice, when I started it right after I left the IRS, I needed every penny of that because I was using that to support my family, right? That was my job, my wage, was my business. But for some people, and maybe in my situation now where I have businesses where I don't need the money to live off of, those funds can stay in the business and be used to invest in the business or whatever the business happens to be doing. So lots of different play as far as the tax brackets go. Notice that even if the tax brackets increase, nobody's talking about going over 40%. And so we would need to go back 30 years, back to the Carter and Reagan years, where we get into a tax rate that high. So again, I'm not worried about tax brackets really increasing much, certainly not this year, probably not next year. All right, standard deduction. Taking a larger standard deduction, meaning we're not itemizing our deductions, and I'll explain the itemized in a minute. So if I'm a single individual, I get almost 13 grand. And if I'm married, I double that to almost 26 grand. And so what this means is that I can take this amount, let's say I'm married, I can take whatever all my income is and subtract 25,900 from it. And whatever that number is what I'm going to be taxed on. So that's if I'm taking a standard deduction. Now, there was one change that's in play for 2021. Right now, not in play for 2022. And that is that if you do claim the standard deduction, you are also permitted an additional $300, or double that if you're married, filing joint, for charitable donations. These are COVID type tax provisions here. It's not been extended for 22. I don't think it will be. So I'm going to put a little X through this, although I don't know that. But for 2021, if you haven't filed your return yet and you're not going to itemize, make sure that you claim this. Again, that's not hitting the grand slam when you get an extra $300 of a deduction. But the question is, do you want the $100 of tax savings, or do you want the IRS to have it? Other things on as far as the itemized deductions go, and this is our mortgage interest and our real estate taxes and income taxes we pay to states and things like that. If we claim our charitable donations as an itemized deduction, our typical rule, and this has been the rule in every year but two that I can recall since I've practiced tax law, and that was 2020 and 2021. But basically, this rule says that no matter how much money you give to charity, you can only claim a deduction of up to 60% of your adjusted gross income. So what does this mean? Well, It means that if my adjusted gross income is 100 grand, my charitable donations can't exceed 60 grand. And that's fine for most of us. That's not even an issue. But if it is, in 2020 and 2021, you could in effect zero out your income and not pay any tax. Now, again, this is something that maybe you want to do and maybe you don't. And here's another example of understanding options. And don't always think that you're stuck with one particular option. So this is in 2021. This person has an AGI of 200 grand, pays some mortgage interest and taxes here. And so we've got a taxable income at this point of 175,000. This person can make a donation of the full 175 and zero out the taxes and fully save this amount. Great deal if that's what you're looking to do. This person, though, in the same exact year can say, no, I don't want to zero that out. Well, why would I pick that? Well, because my tax rate here is so low, 14%, and the charitable donation that I couldn't use, the portion that I was limited because of the 60%, this 55 grand, gets carried into the next year to be used. So again, simply because there's a tax rule that, on the surface looks pretty good, doesn't mean that it is good. And it doesn't mean necessarily that you should jump all over it.